Hey everyone, Ted Bauman here with your Bauman Daily Friday video. And now I'm going to dress up as Clint Lee for Halloween, so I wanted to share my costume with all of you here today and get some feedback and see what you think about it. All right, that was my bad attempt at some Halloween humor. Thanks for bearing with me through that. Ted is actually dealing with the aftermath of Hurricane Zeta today and some power outages that he's having in his area. So don't worry, Ted's doing fine, and he's going to be back with you here next week. So today I'm going to be bringing you your video, and there's a couple things I want to talk about. One is this surge in stock market volatility that we've seen here recently, and then also talk about some charts that I'm paying close attention to as we move into the election and some levels to follow once we start to get the election results in. So first, this pickup in volatility that we've seen. The markets have fallen, the S&P at least has fallen by about 7% just from a couple weeks ago, and we were starting to get right back toward that prior high. And you know, we're right in the thick of earnings season. We're coming up on the election, so it seems like that would have a lot to do with it. But I think one of the main things that's driving the volatility is the recent uptick in COVID cases, new cases that we've seen here. Now, let me explain. So here's a chart of new COVID cases here in the U.S. This comes from the New York Times website. And you can see we're kind of in this third wave now. We're setting new records for a number of new cases, peaking out at over 80,000 new cases. But the concern is that we're going to start to see some form of lockdown again. And that's because of what is going on in Europe. So I want to show you a chart now of new COVID cases in Europe. And this goes back to the start of the year. And as you can see, Europe never really had sort of that second wave in the summer that we experienced. But look at the surge in cases that they've had just over the past few months. They are now topping out at over 200,000 new cases, more than double the records that we're seeing here in the US. And this is starting to overwhelm healthcare systems again. And because of that, you're starting to see countries like Germany, France have come out and they're implementing lockdown measures once again, shutting down non-essential businesses. Britain's under pressure to do the same thing. And so the concern is that if we are starting to follow Europe's trajectory, if we keep seeing this increase in new cases, that we're going to start to see some form of lockdowns being implemented once again, whether on a state-by-state basis or within states at the county levels, whatever it may be. There's sort of this threat out there of lockdowns once again, and it comes at a horrible time because we have not been able to get that next federal stimulus package. As we know, Democrats and Republicans, I mean, they worked on this for a while. There's always supposedly this breakthrough in negotiations, and they kept getting closer to an agreement, but it never happened. And we finally got up to the point, we finally got close enough to the election. They just kind of punted on it until after the election, which still creates more uncertainty because without having something already voted on and in place, we don't know once election results are in, what Washington is going to look like. Now, right now, the polls would seem to favor the Democrats coming to power in both the White House and in Congress, but as we know from 2016, the polls can be way off in their predictions. So once again, we have this surge in new cases. We have the prospect of lockdowns because of what's happening in Europe, and this would all be happening without another round of stimulus package. And now, from a stock market standpoint, not only do we not have another stimulus package in place at the federal level, but then also the federal government level, but with the Federal Reserve, they're pretty much out of ammunition at this point. And they've been very vocal in pointing that out, that rates have been slashed to zero, that more QE is just not as effective, and that they're really, Federal Reserve officials are limited in terms of what they can do to provide further support to the economy. And as evidence of that they have been slowing down and they really haven't been doing anything extra incremental. Look at this chart here of the Fed's balance sheet assets. Now, the reason we track Fed balance sheet assets is because when the Fed's been embarking on QE, they're basically creating new cash, or they're creating cash out of thin air, and they're using that to buy an asset. Now, in most cases, those assets have been treasury bonds. Well, when they buy that treasury bond, that becomes an asset on their balance sheet, so we can track how much QE is being done out there by tracking these balance sheet assets. And this chart goes back about a year, and you can see this surge in the balance sheet right as the pandemic was setting in, and about $3 trillion in QE was done from late February, early March into May, but nothing's been done since then. I mean, look at this line. For the last 5 months or so, it's been stagnant. It hasn't gone anywhere. So not only do we not have a stimulus package from the government, but the Fed itself is saying we can't do anything else, and they really haven't been doing anything else. And so that, to me, is why you're seeing a lot of this volatility setting in here all of a sudden, in addition to corporate earnings reports in the upcoming election. Now let's talk about the election for a minute, because there's several charts I'm following outside of the stock market, but will nonetheless give us some great information about what is going to happen with stocks and where new opportunities, where new leadership opportunities might be emerging. Now it's something called InterMarket Analysis, something that I'm a big fan of. It's taking a look at what's happening in other financial markets, like in fixed income or in commodities, to try to gain some incremental information about what that could mean for stock prices. And so probably the biggest question right now is, are stocks going to go higher or lower in the aftermath of the election? And to answer that question, probably the most important chart that I'm keeping an eye on is high yield bond spreads. Now, the high yield bond spread, all that is the interest rate that someone buying junk debt is demanding above and beyond a treasury security. So if that spread is moving higher, that means junk bond investors are more worried about being repaid. They're more worried about the issuer of that bond defaulting, and so to compensate for that, they push that spread higher, and vice versa. When things are looking good, when the outlook for that company is improving, they don't demand as much extra compensation, so that spread moves lower. So here's a chart of that spread that I'm talking about. This goes back about a year now, and I wanted to show this box on the left-hand side that I highlighted. This is the pre-pandemic level. This is a level that these spreads were at before the pandemic. Then you had this surge in spreads as the pandemic set in, as we had the lockdowns, the uncertainty over the economy, the fear of defaults pushed that spread higher, but it's stabilized since then. It's worked its way lower. But it's still well above sort of that pre-pandemic level. So that's what I'm watching for right here, and that's what I've highlighted with this dash line. We've really struggled over the last several months to break below that 3.5% level, which is where that dashed line is at. So what I'm looking for is that in the aftermath of the election, if we can see spreads go back below 3.5%, if we can take out sort of this trend line support that I'm showing on here, that means the outlook for companies issuing junk bonds is becoming better, is becoming more clear, and that would have positive implications for stock prices. Now, vice versa, if this line were to start to turn higher again, that means the outlook for these companies is worsening, and would expect stocks to be falling in response to that. So there's something outside of the markets to keep a close eye on. Now, I'm also paying close attention to interest rates. Now, the main interest rate that I'm going to monitor going into and following the election is a 10-year Treasury yield. Now, falling interest rates throughout this year has been a huge boost for stock valuations, and that's especially true for tech stocks and growth stocks. Just the way sort of a cash flow analysis, a cash flow valuation works, when you have falling interest rates, it makes those future expected cash flows worth a lot more today. And that's been a big boost to not only the stock market, but especially to these mega cap tech stocks and these high growth names. So here's what I'm watching for now. So we had this is the chart of the 10-year Treasury. We had this decline following the pandemic, but really since late March, we've gone nowhere. We've traded sideways. And so, but we've been backing up here recently. So that's what I'm highlighting here with this dash line, is we're coming up just below that 1% level again. If we can start to break above over this dash line that I've shown on here, I would expect interest rates to keep increasing, even that pace of increase starting to quicken, and that would be bad news for the valuations in the growth space and the tech space. It would be good news for stocks, the cheaper stocks in the value space, and more on the cyclical side. We've already seen a pickup in performance there. I mean, even with yesterday's setback in the stock market, the Russell 2000 index of small cap stocks are having one of their best months in the last 4 years or so relative to large caps. So if we want to see that performance in those cyclical areas of the market and those value segments of the market keep picking up, we need to see yields continue to work their way higher here. So this is a key chart that I'm following as we go into and exit the election. Now, last chart I want to show you here is the U.S. dollar index, and I'm paying attention to the U.S. dollar index to evaluate opportunities in the international space. So for this chart here, this goes back for a decade now. Over the last decade, the dollar's been strong, and we know that U.S. stocks have absolutely trounced the international space. But over the last several years, we started to kind of carve out sort of this triangle pattern. We can see these areas of resistance and support that I'm highlighting with these dashed lines, and we now find ourselves back on that dashed line at the bottom here. If we can start to break below that, if we see downside in the dollar start to pick up, that is going to be a big boost to international areas, and that's for two reasons. Number one, if you hold an international stock and the dollar's weakening, that helps boost your returns. But then number two, when you see the dollar weakening and that money flowing to other areas, that's people voting with their dollars that they see better opportunities in international markets. So that money's going to flow to where it can earn the best return. So once again, the aftermath of the election, if we're going to see performance of international areas pick up, which is something we've talked about a lot in our Bauman Daily commentaries, how cheap several international markets are and the opportunities that are out there, this is a key chart to monitor to see if those areas start to pick up in performance relative to the U.S. Well, that is all that I have for you today. This is Clint Lee with your Bauman Daily Friday video. Thanks for watching.